To understand the economic friction holding back climate action, look at the math of long-term risk. The projected economic damage of a temperature rise above 1.5 degrees Celsius mathematically dwarfs the upfront costs required to transition away from carbon. Yet, despite this clear mathematical incentive, global financial markets are consistently failing to direct sufficient capital into green infrastructure. We can see the scale of this lag clearly in the regions covered by the European Bank for Reconstruction and Development. This chart shows the projected annual financing required for these regions. To reach the necessary baseline for climate and nature goals, current investment levels need a five-fold increase, hitting €500 billion annually by 2030. This persistent shortfall contradicts the bedrock assumptions of rational choice theory, which insists that markets will naturally optimize for long-term survival. The reality is that the market is structurally blocked by embedded frictions that prevent capital from moving where the long-term math says it should go. That annual €500 billion gap is the proof. Without targeted intervention, the market cannot self-correct its pricing of long-term climate risk. These macroeconomic market failures are driven by microeconomic cognitive biases operating at an institutional scale. At the individual psychological level, this manifests as status quo bias, the natural human preference for existing systems, even when those systems are suboptimal. Scaled to the macroeconomic level, status quo bias takes the form of distortive fossil fuel subsidies and network externalities that keep billions in capital locked inside legacy carbon infrastructure. Then there is loss aversion, a cognitive bias where the fear of a short-term loss heavily outweighs the mathematical probability of a long-term gain. When applied to institutional capital, loss aversion prevents private investors from absorbing the perceived short-term risks of scaling emerging green technologies. Finally, we have choice overload, the paralyzing effect that complex, interdependent options exert on decision-makers. When policymakers face tightly intertwined shifts in energy, supply chains, and local economics, the multiplicity of options frequently results in hesitation rather than action. These cognitive frictions aggregate into structural failures. When short-term fear and institutional habit dominate the decision-making process, the resulting inertia prevents the market from redirecting capital at the scale or speed required by the climate threshold. The European Bank for Reconstruction and Development is attempting to overcome this systemic inertia. Their 2026 to 2030 strategy abandons piecemeal project funding in favor of a synchronized structural intervention. This intervention is built around an architecture that targets 6 interdependent economic systems: energy, industrial, agri-food, transport, urban, and financial. Within the energy system, the immediate mandate is to clear the regulatory hurdles holding back the deployment of physical grid networks and high-capacity battery storage. This chart illustrates the current momentum in global renewable capacity. To capitalize on this, the EBRD targets a tripling of their cumulative renewable energy capacity, aiming to add 35 gigawatts by 2030. Achieving reliable baseload power to support that capacity means evaluating the full suite of cost-effective technological solutions, including coordinating with international agencies to explore the role of nuclear energy. Shifting to the industrial system, the strategy targets hard-to-abate sectors, specifically heavy physical manufacturing like steel and cement. The bank's objective here is to double its policy activities to create specialized low-carbon pathways tailored strictly to these heavy industries. A mandatory element is the integration of circular economy principles, ensuring these sectors maintain their competitiveness in global markets while lowering emissions. Transforming physical systems like energy and heavy industry requires rewriting the rules of the supply chain. It requires moving past isolated technological upgrades to execute systemic, market-wide shifts. The central mechanism making those market-wide shifts possible is the financial system, which dictates capital allocation across all 5 of the physical sectors. The EBRD targets systemic change by acting as an anchor investor, expanding green capital markets to allow for broader project financing. A specific operational target is tripling the coverage of client banks that possess formal disclosed transition plans, pushing that number above 60%. This applies targeted institutional pressure. It forces partner banks to proactively manage long-term climate risk within their own portfolios rather than ignoring it. Transforming the daily operations of these partner banks activates their underlying capital base, creating a multiplier effect for EBRD interventions. This activates a capital pool representing approximately 2 trillion euros in today's value. Mandated transition plans serve as an operational filter, identifying green business opportunities like small enterprise loan products for partner intermediaries. By shifting the compliance requirements of local financial institutions, the EBRD integrates climate risk directly into the machinery of regional capital allocation. This infographic outlines the ultimate cumulative financial target of the 2026 to 2030 strategy, 150 billion euros in green financing. To understand how they plan to move that much capital, we have to look at the behavioral economics concept of the choice architect, an entity that deliberately designs the environment in which decisions are made. To reach the 150 billion euro target, the EBRD operates as an institutional choice architect to systematically override the cognitive biases of both sovereign governments and private corporations. The first tool of choice architecture utilized by the bank is the implementation of defaults. Internally, the bank has set a strict default mandate. At least 50% of its own financing is automatically restricted exclusively for green purposes. A secondary default mandate forces strict Paris Agreement alignment for all new projects. This effectively eliminates high-carbon choices from the investment menu entirely. The second architectural tool is the use of pre-commitment mechanisms. Forcing client banks to publicly disclose their transition plans acts as a pre-commitment. It locks them into future decarbonization pathways, structurally preventing a behavioral retreat back to the status quo. That leaves the final, and often most stubborn, cognitive barrier: institutional loss aversion regarding the perceived risks of investing in emerging markets. This diagram shows how the bank uses blended finance to enact a third architectural tool, framing. The EBRD uses its own capital and external concessional finance to absorb the initial project risks, which restructures the risk-return profile for private investors. This strategic framing mathematically neutralizes private sector loss aversion. By lowering the chance of a short-term loss, it makes the long-term investment logically acceptable to private capital. This deliberate de-risking mechanism physically catalyzes private direct and indirect mobilization to confidently address the remaining 150 billion euro financial gap. That mobilized capital physically builds the 35 gigawatts of renewable energy, transforms operations of regional banks, and engineers pathways for heavy industry. A resilient green economy transition requires more than organic market adjustment. It requires a deliberate restructuring of the architecture of economic choice.